Bank stocks under pressure this week as interest rates fell. Joining us now, Marty Mosby, Director of Bank and Equity Strategies at Vining Sparks. I keep asking people whether, as a predictor of the future, a lot of times stocks discount well in advance of when it seems safe. Do you think we're at a point yet where things are bad enough to think that the bottom has been reached in a lot of these names yet, Marty, or you still scared?
No, when you look at it, you got to separate the perception from the fundamentals. So if you look at the fundamentals, the banks grew their earnings per share 30% last year, and returns kept going higher. We look at what, even factoring in the lower interest rates for longer, we still see EPS growth of about 5% in 2019 and 2020, and we see the returns can hold relatively flat. But all that gets wiped away by the perception of what happened to banks the last time we went through a downturn and rates went to zero. So the debacle and the loss of investable funds that happened in that financial crisis is what people still invest in as they think or perceive that there may be some risk of that happening again. So the disconnect between the fundamentals and the perception is really the battle that's going on right now in the marketplace.
So you figure what's different this time around that we wouldn't see the same outcome? Banks are structured differently, or it's a different macro environment?
No, we've been through a decade of restructuring. If you look at the actual balance sheets, the capital positions are significantly stronger. If you look at the actual liquidity positions on the balance sheets of the large cap banks, they've added $2.5 trillion worth of liquidity onto their balance sheets. So they're defensible mechanisms to be able to go through this process and defend against what happens when you go through a downturn is much better than what we had in the last downturn in recession and financial crisis. So we'll be able to have a downturn without a financial crisis next time. But you really have to prove that to investors before they will kind of disconnect from the last experience and recalibrate to what's going to happen next. They can't really appreciate all the differences that has happened over the last decade and has made these balance sheets so much stronger where we stand today.
I mean, I remember when we were all waiting for 3%, we used to talk about it, waiting for 3%. We said waiting for Godot. I mean, it was like 5 years. We were waiting for rates to go up. I guess we're all going to be dead before Godot ever gets here now, Marty.
Well, yeah, we've had inflation, which used to be the worries back in the 1980s, and all the monetary policy was built to fight inflation, has now won that battle. Inflation actually now is percolating between 1% or 2% if you're lucky. The Fed reacted as inflation started to go up between 15, 16, and 17. And now what we're seeing is we got into 18 and 19, inflation's coming back down, which then allowed them to bring back interest rates. So if you kind of parallel that, we don't need a Fed funds rate that's above 2%. We need to be closer to inflation, which is somewhere around 1.25%, 1.5%. So yes, we're going to have lower for longer for a lot longer period of time.
I guess now we know. Now it seems obvious, but anyway. Hey, Marty, thank you.
Exactly.